Hey everybody, it's your boy Sean McLaughlin at Options Sean on Twitter X. Hope you're doing well. Today is Tuesday, right? Tuesday, July 29, 2025. This is the What Are My Options show. This is a completely unscripted, completely unplanned show where I'm making myself available to you to talk about, hey, strategies. What strategy should I use on a trade I want to put on? What's caught my eye? Um, you know, Risk management ideas around trading strategies. And if you have a particular stock you're looking at, you're confused or you don't know how you want to play it with options, let's talk it out. So in the chat section there, you can go in there and throw in your questions. I see one question in there already from Wavy. Can you talk VIX Contango? VIX Contango is probably not my strong suit. The VIX Contango basically is what when the premium and the further dated VIX futures are higher than the shorter dated ones. Look, I don't trade VIX like that. I'm probably not the right person to ask on that. I know there's a lot of calendar spread traders who trade the VIX Contango and use VIX futures to do that. That's not my world, Wavy. But if you have anything else about VIX, I mean, VIX, it's probably popping a little bit today. Not much. I mean, we still have a 15 handle on VIX. I wrote last week, guys, and I'll reiterate here, especially on a day like today when there's a lot of stocks selling off. It's certainly high beta and speculative names. We talk about VIX all the time being something that mean reverts, right? So when VIX spikes, it tends to mean revert lower. And people tend to think, well, it works both ways, right? When VIX is low, then we can tend to get spikes. That's mean reversion back to the mean, so to speak. I will caution you on that thought, though. I think a mean reversion from high back to low is something a lot more bankable than betting on mean reversion when VIX is low. Just because VIX is low should not be your signal to be positioning for a VIX spike. VIX spikes can happen off of lows for sure, but a low VIX is not a signal for me to get long volatility. Now, that said, I do like to be an owner of options, whether long calls or long puts or long call verticals or long put verticals when volatility is low, more so that I could express my directional bets. But then I'll also have the added kicker that if there is a volatility spike while I'm holding long options, perhaps that'll benefit my position. So I hope that makes a little bit of sense. All right, Jackson, I see your question. I would love your thoughts on two trades I just got in the other day, a 25-year base in Cisco. 25-year base and FTDR. All right, so let's talk Cisco first. Let me pull Cisco up. If you want to give me the details on the trade you got in there, Jackson, happy to talk about it. I mean, looking at a 1-year chart of Cisco, which is more my bandwidth, right? I'm more of a swing trader. I'm not looking at putting on trades and holding them for 25 years. But looking at this Cisco and seeing the way it's consolidating high right here, that's very bullish to me. I would be a buyer of this thing if it broke above. I mean, if I want to be more aggressive, if it broke above 69. Maybe if I wanted to be a little bit more conservative and wait for a little bit more confirmation, I'd wait for 70. But I love this chart setup. Let's move this up here a little bit. Let's show the implied volatility a little better. You can see here at the bottom of my chart here, these blue lines at the bottom. This is the implied volatility for Cisco options being charted along the bottom. And we've been rising over the last month or so. It's not alarmingly high. But let's take a look at the options chain. I mean, my preference would be to just buy simple calls here. And if I were to go out to say, I don't know, let's say January, give us approximately 6 months to play out. If I'm looking at the 25 delta options, those are 77 half strike. I don't like that. Let's do the 75 strike. You pay $2 for the 75 calls, well, two and change, maybe 205, 206 for the 75 calls. And that gets you positioned for 6 months. If this thing breaks out, this thing could easily blow up to 80, I would think, and those calls would pay. So Jackson, I don't know what your exact trade is, but I do like this setup. Getting above 69, I think I would get interested. In fact, I'm going to put a little alert in here for me because I might want to trade this one if it gets above 69. I just put in a little alert. This is what I do when I see ideas that I like. I just put alerts in my platform, and when they trip, sometimes I get in, sometimes I don't. All right, FTDR was your other trade. Ooh, that's also a good looking pattern there. It's coiling. You got implied volatility rising pretty notably there in Frontdoor. No doubt it's got earnings coming up soon. That's certainly playing a part. Let's take a look at those options here. I like this setup too. Probably look at more of a bull call spread. Let's see if we have. The problem with these options is they're not super liquid. Like look at these October 60 calls that are just slightly out of the money. Your bid 320, offered 550. You can drive a truck through that spread. Don't like that. Let's see. I mean, do we have any more yeah, even less liquidity when you get sooner, right? If you go to September options, you're looking at a bid of 160, oops, and an offer of 520. So Jackson, I love the setup of this chart. But I think you got to just trade common if you're going to trade this one because the options, the liquidity there is not so great. So there you go. That's something I pay attention to a lot, guys. There's lots of different ways to measure options volatility. Certainly, you could look at the volume, right? And as we see here, there's been no volume today. These N/A, that's none available. No options volume has traded today in FTDR. You could also look at the open interest, which is this column here. Very little open interest. It's a ghost town here. So that alone should be enough to tell me, okay, there's nothing going on here. But sometimes, especially if it's early in the trading day, right? The market just opened. There might not be a whole lot of volume. Um, one way to kind of not short circuit, but go around looking at volume and open interest is if there is a tight bid ask spread, meaning, the bid ask spread is maybe 5, 10 cents, 15 cents at most. If that's the case, then that tells me there's probably enough interest and enough liquidity and enough market maker participation for me to put a trade on there. But this particular case in Frontdoor, this doesn't check any of those three boxes. It doesn't check the volume box, it doesn't check the open interest box, and it doesn't check the bid ask spread box. So without that, this is a no play. So if you like this chart, and I do like this chart, I think you got to play it with common stock. You buy at a break above 60 or so. That's how I would do it. All right. Someone threw in their target. See what's going on in Target. Boy, I don't know about this name. I know my analyst here, Jeff Mackey, who handles retail stocks for us. He's pretty. I don't want to say bearish, but he's not very happy with Target. And he would know more than anybody. His father used to be CEO of Target for many years, so he knows Target better than anybody, I would think. And he's not too happy with the stock. If anything, especially if the market's going to roll over here, this stock to me feels vulnerable. I would probably look at buying puts in this thing. I mean, man, I don't know if you're thinking long there to lack, but for me, I'd probably want to buy puts. Volatility is rising a little bit. Let's see what a put spread in this thing would cost in September. If we buy a slightly out of the money put, like the 100 puts. Maybe do a spread. Buy the 100 puts and sell the 90s. Let's do a vertical spread here. Let's check that, make the strikes. You could buy a 100 put vertical by buying the 100s and selling the 90s. You pay about 296 for it. Let's call it $3. That's not a fair price to me. If this market rolls over, I feel like Target's one of those names that would be highly vulnerable. And could it trade down to 90? Absolutely. Absolutely, it could. So sorry if you were feeling bullish on Target. I'm not feeling it. I'm feeling bearish on that one. All right, considering calls on Standard Lithium, SLA, or SLI, let's check that out. Well, it's a cheap stock. It's a $2.62 stock. Let's see what these options chains look like. The options, yeah, I mean, there's open interest there. Not a whole lot of volume traded today, but that's okay. The bid-ask spreads are tight. I mean, look, if you're looking at, I mean, the furthest you can go out is January options. You could buy the at the money calls there. I don't know if I'd buy those fives. You can buy the at the monies for 65 cents. You're paying a lot of premium, I think, for those. Well, in relative terms, you're paying cheap premium. The option, the implied volatility in SLI is at the lowest it's been all year or near the lowest levels. I mean, you're still paying a 90%, 96% annualized volatility in those options. I don't know. Stocks like this, who asked that question? It was Paul. Stocks like this, I would rather just buy the stock. It's so cheap. $2.62 gets you long the stock, and then you have all the time in the world for your thesis to play out, right? You don't have to worry about any time decay. You could sit in this thing for a while. I would just play the stock. But if you were forced to buy something, go as long out as you can. Buy the Januaries, go buy the 2.5s, pay 65 cents for it. You're basically betting on this thing getting to 350 or higher, which this is one of those names that it could definitely do it. I mean, this stock was back in April, the lows, it was around $1. So we're already up 250% since April. So certainly this thing can go to 350 by January. That's not a crazy idea. Oh, okay. Bernard, what do I think of Souls? That's the Solana ETF. Well, I had a position on in this earlier or mid last week, and I got stopped out pretty quick. I bought on this day, on the 24th. I bought this thinking I was buying a dip and this thing was going to rip higher. Well, I got stopped out the very next day. So I'm not in it right now. I'm keeping an eye on it for sure. I mean, this is the Solana crypto ETF vehicle for equity traders that participate. And I definitely keep an eye on this. You can see I've got a alert set right there at 2139. No magic in that number. That's just an area. It's an approximate area. But if it gets back above 2139, which is basically the high of the day I got stopped out, if we get above there, um, I'd be interested in playing this thing again. You're probably going to pay high option premium for this. You might want to do a spread, a vertical spread. And by the way, when I say things like vertical spreads, guys, let me just do a little educational note here real quick. Let's look in the October options here. Let's pretend we're putting together a vertical spread. We're buying the 20 calls and selling the 25. Okay. It would cost me about 168, give or take. But now let me just bring up the analyze tab of what this trade looks like, what your P&L curve looks like. When you're buying a call vertical spread, you're doing a couple things. There's a couple pros, there's a couple cons, okay? A pro is that you're paying less to participate, right? If I bring back this trade tab, if I wanted to just buy those October 20 calls, I mean, that's a huge spread right there. But let's just say I had to pay $4 for them, right? Maybe I don't want to pay $4 to participate in a bullish idea in Solana ETF, right? Maybe that's too much for me. Well, you can sell an out of the money call against it. You can sell these 25 calls against it for about $1.15 or so, lowering your cost so that your net cost is only $1.68 instead of 20 or instead of 4, right? The trade-off is, as you can see with this P&L graph, the blue line is your P&L, your potential P&L at expiration. Okay. So right now the stock is trading at 19 and change, right? We're buying the 20 calls, selling the 25. So as you can see, as we start getting above 20, my potential profits increase, okay? But they're capped at 25 because I'm short the 25 calls. So the most that spread could be worth is $5. That's the difference between the long strike at 20 and the short strike at 25. The most that spread could be worth is $5. If I pay $1.68, I'm sorry, that's not right. Yeah, if I pay $1.68 for that right now, and I could potentially sell for 5, that means I could, more or less double my money, or yeah, more than double my money, right? Pay $1.68, sell for 5. That would be ideal. Now, I don't usually hold these things all the way to expiration. The way I do vertical spreads typically is I will sell them under one of two conditions. The first condition is if the stock trades up into my strike price or my short strike price, which is 25, if it trades above that, actually, let me back up. That's the second criteria. The first criteria is I will sell this spread for 80% of the max value. So if the most it'll be worth is $5, that's the most it can be worth, I'll sell it at 4. I'll happily take 4. That's 80% of the full value of the spread. Book the profit without having to hold the thing all the way to expiration and risk the market taking all my profits back, okay? So I'll sell this at 4 or 80% of the max potential value. The second reason I would sell this spread is if it got to 25, especially if it got there quickly, like these are October options. Let's say it got there next week or early next month. If it got above 25, I would be sitting on a profit, and how much profit I have, I don't know exactly. I can approximate. This purple line shows me what my profit would be there if it got there today. If it got to 25 today, I'd make about 98 bucks on a one lot, which is not bad, right? I paid $1.68 for it. If I could, so it's a $168 investment for a one lot. If I could sell it and earn 98 bucks, that's a great return in one day. And I would take that return. Okay. So if it gets to over 25 while I'm still holding the spread, I'll take the profit. So 80% of the full value, or if it gets above the short strike, that's when I would sell it. So, but anyway, Souls, I like it. I'm keeping an eye on it. Above 21-ish, I get more interested. Okay, let's see. How about a strangle on Bitcoin or BITO? Okay, let's check that out. So here is BITO. This is a ProShares Bitcoin ETF. I prefer IBIT, just, you know, I think there's more liquidity in the IBIT. Either way, it's going to be a similar trade. But if you wanted to do an iron condor, was that what you're asking for? Oh, strangle, excuse me. If you want to do a strangle in Bitcoin, I don't love a strangle here. A couple of reasons why. Number one, I feel like this stock in Bitcoin, but as represented by this ETF IBIT, I feel like it's just been coiling up here, setting up for a breakout. It could have a huge breakout here. This thing could rip higher. Also, it's Bitcoin, so it could drop 10% overnight at any moment. So if I'm going to put a strangle on, which by the way, a strangle means you're short and out of the money call and short and out of the money put, equal number of each, right? And you're betting on the product staying relatively neutral, not moving too far in either direction. Well, if you have a big move, either up or down, a short strangle becomes problematic. You have unlimited risk. In fact, let's put together an example of what that would look like, of what these trades look like, in case you're not familiar. So let's look in September options. Let's do the 15 delta strike. So we're going to go out of the money here. We'll sell the 57 puts, strangle, and we'll sell the 80 calls. Okay. That's a 15, approximately 15 delta on each. We would get about $1.66 credit. Let's analyze this trade. What's going on here? We don't want that. We don't want that. Okay. So here is what the P&L graph for Strangle looks like. The stock is currently trading around 67 and a half. Okay. And so the blue line is what my P&L would be at expiration day. In this case, it would be November, or sorry, September expiration. Okay, let me just hide positions. There we go. And so as long as if we held this position all the way to expiration, as long as IBIT closes on expiration day above 57 on the low end or below 80 on the high end, which is my short strikes, then I will keep all of the premium that I collected. So today looks like I could sell this for about $1.66 right now. So I would keep all of that premium. Okay, that's $166 per one lot. Great. Okay. However, you will notice if IBIT has a huge breakout, if Bitcoin has a huge breakout in either direction, you'll notice our losses are theoretically unlimited. This thing just keeps going down and down and down because we're naked short those calls. Okay. Same thing on the put side, although of course IBIT can go to zero and that's where our floor is. But for all intents and purposes, we have theoretically unlimited risk in a strangle. And so getting paid $1.66 to put this spread on doesn't feel to me all that attractive. See how back at the chart here on IBIT, notice how on the bottom half of my screen here, the bottom slide of my screen, implied volatility has been trending lower since these options first became listed. The options are getting cheaper and cheaper as they are. I would much rather do a strangle when volatility is up here at the higher end of the range because I'm going to get a lot more premium. This trade that I'm putting on right now for $1.66 back in April, I could have probably put a similar trade on for $3. Okay. A lot more premium, which gives me a lot more room for error. Okay. So I don't like a strangle here in IBIT. If anything, I'd rather get long a strangle. I'd rather buy that strangle, pay $1.66 for these for the September 80 calls and the September 57 puts, pay $1.66 for it. And let's see, like if I flip this over, right? Now I'm long. Now I get paid if there's a big move either way. Maybe that's what you were asking. Who asked that question? Who was that? Bernard. Maybe that's what you were asking. Maybe you wanted to be long. I don't know. You weren't very clear, but I'm assuming you were talking about being short. Most people, when they're doing strangles, they're selling them. Yeah. Uh, Bitcoin, I mean, just look again, just to reiterate, let's look at that chart. This thing looks incredibly bullish to me. It's just setting up for a big move. I think there's a breakout coming, and I think that breakout is higher. And I don't want to be short naked calls into a higher breakout. All right. Let's see. Vive. Ugh. In one of my accounts, I just closed Vive. I'm still long in All-Star options. We have a longer term play in Vive. I've been loving this setup. And I thought yesterday's action was very constructive. I thought we were finally going to get a big move. Today's trading action is pretty concerning. I don't like that. I don't love it, but it's, right back in the range. It's okay. If it gets below 276 or so, then I start getting really concerned. But in All-Star options, I'm long a vertical spread in that. Um, Forget what we're at, what our position is, but we're long options. Look, volatility is rising right now. So if you like this trade, if you're bullish this trade, you too probably want to do it with a bull call spread. Let's look it up here. Let's go into October. Let's go to December. If I were positioning right now, fresh position, and trying to play for a breakout, trying to play for a $300 roll, right? It looks like a $300 roll is imminent right now. And maybe getting that $300 roll, you can get it at a discount today. I think you could buy. Let's look at January. Let's just go January. Let's buy the 300 calls. Let's maybe do the 320s to sell it against. Let's see. It'll cost you 735. That's a good price. That's a fair price for that. Again, it's a vertical spread, right? So your gains are going to be capped on the upside. But I think there's a really good chance the stock rips up to 300 and beyond. And maybe the way you play it is you put a bull call spread on, you buy the January calls or call spread, you buy the 300, sell the 320, maybe you buy two lots, right? Or maybe you buy more, whatever your number is. But let's say you bought two. I think what I would probably do, what I would want to do is when the stock gets to like 305, because here's what happens with $100 rolls. In case you haven't heard what a $100 roll is, it's stocks love trading up to big round numbers for the first time, right? So think 100, think 200. In this case, think 300. Those big round numbers, they're big psychological numbers. They don't mean anything in the grand scheme of things, but the fact is, humans trade stocks and algorithms built by humans trade stocks. Okay. And humans love big round numbers, especially when they're getting there for the first time. All right. And those big round numbers tend to act as a magnet. We've seen it over and over again. When a stock gets to 90 for the first time, 91, 92, it's almost an inevitability it's going to get to 100. But here's the thing. The stocks don't just go to that big round number and just do full stop right there. They tend to overshoot. They tend to overshoot by 5, 6, 7, $8. That's pretty common. And after they overshoot, then maybe they'll pause and consolidate or pull back. So with Vive, I'm thinking this thing gets to 300, but it's not going to stop there. It's probably going to get to at least 305, maybe 310. So we're long the 300 calls, short the 320. I think what you do is when you get to 305, you sell half of the position, right? If it got there today, which it won't, but if it got there today, I'd be sitting on $475 of open profit if I bought a two lot. Okay. I'll be sitting on probably a little bit more. Well, who knows? We don't know. There's a lot of factors that come into play here. How much time decay has happened, how much volatility has changed. But either way, if the stock gets to 305, I would sell half and then I would hold the rest and then sell that other half either when the full value of the spread gets to 80% of the full value. Excuse me, when the value of the spread gets to 80% of the full value. So the most this spread could be worth is $20. That's the 300 strike versus the 320 that we're short. Because I would sell it either for $16 or sell the rest of it when it gets above 320. Book a nice profit. So that's what I'm thinking on Vive. I'm disappointed in how it's trading today, but maybe this is just the discount we all needed to ride this thing to the $300 roll. Look, I'm still long in All-Star options. One of my other accounts I closed today, but that was a shorter term trade, so I had to. I had August options in that thing. Okay. What else we got? I don't see any other questions in here. Guys, if you got questions, now's your time. The floor is open. The floor is open. And it doesn't look, it doesn't have to be anything about a particular stock. If you have just a general question about options trading, about strategies or position management, um, anything like that, throw it in there. Happy to answer. This these little 30-minute sessions that we're doing here with the what are my options, these are meant to be kind of like an office hours, right? Ask me anything. An AMA, is that what the kids call it on Reddit? AMA, ask me anything. And so we're making this available to you. It's instructive to you. It's beneficial to me. This is all good. But I don't see any more questions coming, so I'll hang out for another minute or so. If I don't see any more questions, then we'll wrap it up. But boy, we've finally seen a rollover in the SPY. I don't know if you guys follow me on Twitter, but I was tweeting earlier this week that even though the S&P was making new all-time highs these last 4 or 5 days, I mean, same thing in the Qs. If I pull up the Qs, the Qs and the SPY have been marching higher, right? So if you just look at the indexes, you'd think, oh man, portfolios are doing great. But if you're a trader like me, who's been riding a lot of these speculative names, a lot of these high beta names, my portfolio peaked on Wednesday last week, and I'm well off my highs right now, which is a bummer. But that's information, right? One of the great things about being an active trader is when you have a lot of small positions on and a variety of names, you get a better feel of what the actual market's doing better than what the indexes tell you. All right. And so for me, red flags were popping up on Thursday and Friday, and then yesterday. A lot of my high beta positions rolled over hard, and it stings and it sucks. My risks are defined and I accept those risks, but man, I had a lot of open profits that I'm giving back right now, and it doesn't feel good. So to see the Qs potentially have a red day today, and SPY potentially have a red day first in a while, it wouldn't surprise me at all, because we've been seeing it under the hood over the last few days. Okay, I see a question there from Aaron. With a small account, how far would you let a loss go? Well, small accounts are tricky, right? You don't have a lot of leeway, but a general rule of thumb that I follow, and I know this is harder with small accounts, but I don't like to risk more than 1% of my equity in any one trade. So if you have a $3,000 account, then you're looking at risking $30 a trade. That's tough. It's doable with options, but you got to be a little bit more. You got to be a little bit more vigilant on your open positions. But with a small account like that, yeah, you're risking more. You're definitely risking more. I mean, I don't think I would risk more than. I mean, geez, I get uncomfortable risking more than 2% of my equity. Obviously, I'm trading with a lot more than 3K in my account, but I generally get very uncomfortable risking more than 2% of my equity. Maybe a rule of thumb for you with a really small account is don't risk more than $100, right? If you lose more than $100, you don't want to lose more than $100. So either structure your trades so that you have defined risk at $100, or just watch your trades like a hawk and get out when you're down $100. I mean, that's it. It's tough. Look, it's tough. When you're trading with a small account, it's tough. Your options are limited. Um, uh, there's only so many trades you can trade. You can't trade like the big high flying names, the expensive stocks, right? You have to trade kind of in the smaller, cheaper names. I'm not saying it can't be done. It's just, you gotta be a little bit more careful. Jackson says, how awesome will your meetup on August 11th with Brian Lund be? Well, Brian Lund, he's a good friend of mine. I like to bust his balls a lot. It's awesome he's coming to town. I live in Colorado. I run a traders meetup group here in Colorado. We meet twice a month. We're having a meetup in Denver on August 11th. My friend Brian Lund's going to be in town. Can't wait to see him. He's going to hang out with us. So Jackson, if you're in town, hope you come out, dude. Come on out. Be great to meet you. All right. Bill says, with a spread with options prices past the spread prices, but the spread gap hasn't been reached, why? I think what you're asking, Bill, is let's go back to one of those trades we were talking about earlier. Let's talk about Veeve. Um, so I think what you're asking, Bill, is when a stock moves past the strike prices. So if I'm long the 300 calls and short the 320, let's say the stock's up here at 350, right? I think what Bill's asking is, why isn't that spread worth the full value at that point? Because you're so far in the money, right? The full value of the spread could be 20 bucks. And if we're trading at 350, shouldn't the spread be at 20 bucks? Well, the answer is because you have a lot of time left until expiration. In this case, in VIV, we have till January. That gives this position plenty of time to roll back, for the stock to pull back on us. And so there's a lot of time left, and there's going to be a lot of premium in these short calls. So these 320 calls that I'm short, there's still going to be a lot of premium. You want that premium to go to zero. When that premium gets to zero, that's when you realize the full value of the spread. But when there's still a lot of time for the stock to reverse, there's going to be a lot of premium in those options, and that's why you're not achieving the full value of the spread. You just have to be patient in that case. Do, 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 do. TQQ. What? That's one of the leveraged names, right? Yep. That's the Pro Shares Ultra Pro TQQ. I think it's a 2x leverage. Look, man, if you're bullish the Qs, you buy them, right? Volatility is cheap, you buy calls. Can you buy calls? Yeah, you can buy calls in this thing. I don't trade this thing very often, or if ever. But I mean, look, let's just keep it simple. Volatility, implied volatility is low. If you're bullish on the Qs, you just buy calls. I would buy probably the 25 delta calls, whichever expiration you're looking at. But calls are the play here when volatility is cheap. If you think we roll over here, you could also buy puts. Puts are cheap in this scenario as well. Who asked that? Dark tan man. It's summertime. I hope you're a dark tan man. I'm working on my tan. All right, folks, we've gone a little bit more than a half hour. It looks like we've exhausted all the questions. Thanks for tuning in for What Are My Options? We'll do this again next week. I'll be on location next week. I'll be live, coming at you live from a cabin in the woods in upstate New York. The cabin in the woods has Wi-Fi, so I will be there. We'll do this again next week, same time, noon Eastern. Looking forward to it. Until then, guys, if you have any questions at all, shoot me an email, info@allstarcharts.com, or hit me on Twitter @OptionsSean. I'm happy to engage with you there. Have a great rest of your trading day. I hope you survived this little bout of volatility we're having. And certainly if you're trading the high beta names like I am, stay on top of those positions. I'm trimming losers here. I've been actively trimming losers for the last 2 days, reducing risk because the markets are speaking. All right, everybody, have a great day. We'll talk to you again soon. Bye-bye.